Today, folks, I gotta own up to it. I was wrong. And what I was wrong about was thinking that these stocks wouldn't go any higher when we're talking about things like Nvidia and Palantir. If you go back just like a month ago when they started peaking around 420 for Nvidia, when we're talking about Palantir, when it was hitting about 16, I said, be very cautious here. The market is chasing these tech companies and they're just starting to get overvalued. Lost some subscribers. People always get mad at me. And sure enough, these stocks went incredibly higher. But I had one sustained thesis that is now panning out, and that is what I said about waiting till earnings. I said earnings are probably going to be fine, but underwhelming if the past quarters have anything to say about it when we're talking about tech companies. And Tesla just posted, taking the rest of the tech market down with it. I mean, we're going to see Meta, we're going to see Google, we're going to see Microsoft posting earnings next week, followed by Apple coming into the beginning of August there. And I think that is the final breath probably for this extended rally. I don't know how far this is going to sell off. I think these companies are incredible. I honestly want to buy some Tesla stock, and I missed the boat, and I'm very disappointed that I didn't have the fortitude to buy some of those lows to rally back to these highs. But I am going to be setting some money aside, and I'm hoping we see that breath back down to the $200 range. It may or may not happen, but I think I have plenty of time to be patient with something like Tesla that is, you know, they're shutting down facilities to do upgrades next quarter. They kind of lowered their own guidance just through the conversations. I mean, you're talking about a company that doesn't have any AI software in play here in any realistic way for revenue generative off self-driving or robotics. But the fact is they're obviously a leader now in the entire auto industry from sales. They're just cutting margins. You know, they're bringing the cost of the cars down. And this is just the macro environment that I think should start beating up this overextended stock price to give me an opportunity to buy for that long-term thesis if it pans out over 10 or 20 years. And like I said, if AI self-driving was generating revenue literally tomorrow, I would pay any price for Tesla. But that's going to lead to macro volatility because eventually revenue and earnings will matter. But what is value in the market? Where can we turn today? And I have been loving fast graphs. This older gentleman here, I think, gives really good insight into aspects of the market that people just have been crapping on aggressively. And I think that is where you should be buying, is the lower half of the S&P. I said this, you know, I think the bottom half of the S&P, the PE ratio sits between 15 and 17 if it wasn't for these overextended tech companies driving the valuations up. And eventually, if money keeps flowing into the market from money market funds and people start taking profit on tech, they're going to want to find a new place to put that money. And my best guess is going to be in these companies that are extremely discounted. And right now, let's talk about some of those dividend stocks, because that's where the juicy value and income is going to be generated. I think you can get some good gains and lock in some good yield on cost when we're talking about, we're going to dive into the telecom sector. We'll talk about some healthcare stocks and some REITs. But in the telecom side of things, I've been really looking at Verizon Communications here, because this company's got a 50% payout. They can definitely afford the dividend, and they're just getting slaughtered when it comes down to the actual balance sheet of high debt. All these companies are experiencing these headwinds of obviously a lot of the market just selling off because they're dropping. It's that reverse psychology. Buy what's going up, sell what's going down. It seems to be the way it goes. And these companies have headwinds of debt. They have headwinds, obviously, we'll talk about AT&T and some of those headwinds, but you can't help but recognize that this company's valuation is just getting too favorable for any headwinds they're about to face. I mean, this company is just trading in the absolute toilet. I'm glad it's a larger position in the CHD index, or my ETF, where I'd be buying probably the stock individually at this point with a 7.7% yield, a 6.5 PE, guys. AT&T has been getting clobbered by a lot of investors out there saying it's a garbage stock. There's recent news that they're going to have to pay, you know, billions of dollars to replace some of the lead cabling with these regulatory issues. And yeah, I think that's going to be a headwind for them, but the company, I think, is fair just here for the amount it's dropped. I mean, they did a spin-off, so they cut the dividend on the spin-off, which people took that into a negative front, and it just led to, you know, a 3-year decline. I think they're sitting below 5-year lows here. It's just kind of astounding. And at this point, if you're selling it off, I think you're just being foolish. I could be wrong. Again, I'm not offering financial advice here. And even on the Canadian side of the border, the Canadian telecom giants are finally starting to take in those headwinds as well. We survived a lot of it here in Canada, not seeing the same sell-off, but now it's happening, and it's happening for good reason, because again, TELUS, in this really double-edged environment where they're hitting record customer acquisition, record revenues, they're just getting destroyed on interest rates. And people are like, oh, no, run, don't buy these, sell these. The dividends are starting to explode. They're doing layoffs. I mean, TELUS is doing severance package buyouts here, just trying to get people out of the company, even though, you know, the dividend has been fairly sustainable. The great decade dividend growth from 13 cents to 36. I mean, you're talking about just astounding past performance. This does not state into those future returns here, but inevitably they're going to lower interest rates. And that's when the bull market will take off for these kind of companies. I've stated these are recession proof companies. That doesn't mean the stock price won't go down. Absolutely. In every kind of recession, the stock has the potential to drop up to 50%. But the fact of the matter is it's recession proof because it will always damn near survive. This is a company that is fundamental infrastructure to the way we live. You really think your phone bill is just going to vanish? These companies are going to go bankrupt? No, that's probably not going to happen. Look at Bell. Bell's doing massive layoffs right now. I mean, they're down 21%, roughly 2030 from the peak, 6.68% yield, in astounding decade dividend growth as well. And here they are, laying off something like 1,300 people on the media division with all the stuff going on in Hollywood right now. It's affecting the entire media sector. And Bell owns CTV, some radio stations, and they're just saying, hey, we don't need this. We have more stable income on other aspects of our business. They have Crave. They probably get more reliable subscription revenue from Crave, and they just don't want to fork out big dollars anymore to deal with this media and CTV and probably things that aren't as margin intense or not as margin increasing. And yeah, I still think if you're looking for value, guys, that's where it's at. Look at healthcare. I mean, we talked about Pfizer. Pfizer, I think, is trading at a good value. J&J is one that my fiance still holds that I wish it was part of I don't even think it's in the SCHD ETF, but this is one of those buy, ride or die, hold forever kind of companies. They have such a diverse portfolio, and they just posted earnings and they popped up 5.85%. Yeah, not huge yields, but they were trading at a discounted value for being one of the top 20 or 30 largest S&P 500 companies. This is where I still think value and money will probably likely start to go. J&J over the last decade from 50 cents roughly to $1.13, doubling that dividend. And look at this. Their segments are incredible. On the pharmaceutical side, over almost every aspect of the pharmaceuticals have seen growth. Almost every aspect of their med tech highlights are now seeing some growth. Look at interventional solutions are up 56 frigging percent. You get into consumer health highlights, almost everything's up across the board, which is very nice to see, with some of the biggest segments growing in women's health. There seems to be a big fixation on women's health. I think this is related to a lot of TikTok trends, baby care. I mean, this is one of those foundational companies that I think has been underappreciated in the current market environment. So you just be patient. Look at the lower S&P 500 companies and just watch what happens here when it comes to financials, when it comes to healthcare, when it comes to telecom. These are the companies that need some light shined on them, and I'm hoping that I'm providing some insight that these will be the things that probably provide, I think, in the latter half of the year, better growth than tech will likely offer at this point after this overextended bull run. Look at Medical Properties Trust. I almost want to buy back into this one. I've been debating it. I keep saying that there's a lot of value out there with things like PayPal, MPW. I've been following pretty aggressively here. Just depends on once I get through this real estate transaction, the exact capital I've left over and how I'm going to allocate it. But taking a look, this company's finally starting to rally. People have finally gotten over the drama. I mean, if you bought some of these lows, you're up pretty substantially already with a super high dividend yield. And, for a medical company, how you think hospitals are just going to go belly up? You think they're just going to all disappear? I highly, highly doubt that. This thing is trading at 2008 levels. And again, we're talking about a dividend that hasn't been cut, that has been fairly stable since 2010 here, where they've gone from 20 cents a share to 29 cents. Yeah, we're not talking about huge dividend growth, but a 10% yield starting. It's a great place to generate cash flow today at a good value where you could see substantial capital appreciation. Now, these are obviously just my opinions, and if you want to hear more, I'm doing live streams every Friday. Join that tomorrow, 9 p.m., or consider joining my Patreon member group where we can talk directly one-on-one within my chat group of 6- and 7-figure investors, where we just kind of riff on this stuff every day of the week, along with some private videos and insights into my personal finances, linked down below. But as always, I look forward to catching you in the next one.